50% of landlords are thinking about selling up in 2025. But why is that, especially now when we're seeing rental yields the best we've seen for quite a while? Now, some of tax changes coming into effect this year from the Labour Party may have something to do with it. But I'm going to share with you one particular tax that has reshaped the UK property market, and it's still hitting landlords hard. So in this video, I'm going to break down the key changes for 2025 in terms of tax, but also I'm going to explain the number one reason landlords are selling up, but most importantly, what you could do about it. Now, if you're a landlord, this might be an update that you don't want to miss. Stay tuned. So let me take you back to 2015 when the then Chancellor George Osborne announced in his autumn budget that he will be implementing a surcharge of 3% stamp duty for second homes. The new rules by the then Conservative Party were meant to help the housing crisis that we were experiencing by helping first-time buyers, but also just those moving home being able to access the housing market. The government hoped that by making it more expensive to purchase buy-to-let properties and second homes, it will free up more stock and make it easier for these buyers. But actually what happened was by increasing the stamp duty, it made rent more expensive. And what we found over the course of the years was that buy-to-let investors continued in the industry. So that brings us to 2024, where the Labour government has come into power and has then taken the 3% to 5% as announced on their autumn budget. And that has kicked in April 2025. Stamp duty land tax is tiered, which means that each portion of the property's value is taxed at a different rate. Here are the new rates. So as you can see, up to £125,000, it's 5%. And then that works its way up, all from 7%, 10%, 15%, and then 17% for anything above £1.5 million. So when it comes to buy-to-let investors in the capital, this is where it's going to have the biggest impact, because of course it's where we have the highest value properties in the country. So let me share with you a story of a buy-to-let investor. Meet Priya. She owned one property. Not sure if she could be considered as a buy-to-let investor, but she did own that property for several years in East London. After careful planning and receiving rent from this East London property, she wanted to build up her pension pot because she was not getting any younger. And what she decided to do was to buy a property in 2025. However, now with this 3% and then gone up to 5% stamp duty tax, this has changed her plans, because now she's looking at, instead of £20,000 before in 2024, now in 2025, she's now looking at 5%, which is going to be almost £40,000 tax. When you take these tax brackets into consideration, this could be almost double. Now for Priya, this changes everything, because when you look at the amount of deposit, but also renovations, it means that what she's looking at is going to stretch out even further. So this may not change her mind, but it is a strategy that she's going to have to rethink. Now if you take this story and multiply it by thousands, you can see the impact of this tax changes in 2025. Let me put it out there. This video's purpose isn't to bash any government in particular. In fact, I speak to landlords on a daily basis, and a lot of them say to me that they don't believe this government is any more landlord friendly than the previous one. And if you're watching this video, leave a comment below. Let me know your thoughts about the changing governments and the taxes that come along with it. If we look at the spring budget of 2024, we can see the furnished holiday lettings regime being abolished. Tax relief being stripped includes no more mortgage interest relief, no business asset disposal relief, standard 24% capital gain tax will now apply, no more capital allowance, and FHL profits no longer count for pension contribution tax relief. And also now joint owners will have to submit a Form 17 to avoid by default your income being counted as 50-50. Simply put, if two people own a property, like a married couple, the income from it usually by default for tax purposes is going to be 50-50. But now if one person owns more of the property than the other, example 70-30, now you must let HMRC know submitting this form. And if you're finding this video helpful, smash that like button. It really does keep me motivated in pushing more of these videos out there for you. And capital gain tax adjustment represent just another consideration for landlords and investors who are thinking of selling up or offloading some of their property portfolio in 2025. Well, the government did cut capital gain tax rate for residential property for higher earners from 28% to 24% in April 2024. This reduction doesn't necessarily compensate for the drastic drop in the tax-free allowance. So what exactly are the individual income tax rates and bands for 2025? Now, your personal allowance is what you're allowed to earn before you actually start paying tax. So if we look at the figure of £12,570 and it's been frozen until 2028, the government confirmed as part of the autumn budget 2024 that the freeze will be lifted from 2028 to 29 when tax bands rise in line with inflation. It generally leads to lower tax bills. So for 24 to 25 and 25 to 26 tax years, landlords will pay 20% of rental income of buy-to-let properties. And this is between just over £12,500 rent to just over £50,000. And get this, the higher rate threshold for rental income is just over £50,000, of which you will have to pay a whopping 40% of tax or for profits for anything above this threshold. The additional rate, 45% threshold, is £150,000 and above. Making tax digital, MTD. Government's initiative to make all tax returns digital has faced a number of delays in recent years. The previous Conservative government may have been rather ambitious to try and aim at have this introduced for all self-assessment by 2023, because it's now set from this government to 2026. Landlords who earn more than £50,000 will have to submit their tax returns using a compatible software by 2026. And those landlords who earn between £30,000 to £50,000 will need to start submitting it by the 6th of April 2027. And what about those landlords earning under £30,000 rental income per year? Well, the government has confirmed that those earning over £20,000 will also be introduced to the MTD by the end of the current parliament. And just a quick disclaimer, this is in no way financial or legal advice. All these tax changes are significant, but there's one tax that changed the game, especially for landlords who I speak to on a daily basis. And the odd thing about this is, it's not a new tax. So why all the fuss now? Well, let me take you back to 2015 when the then Chancellor George Osborne announced Section 24, which was the end of landlords being able to deduct their mortgage interest from their rental income. So effectively, they will be taxed now, not on their profit, but on their turnover. Some landlords, unfortunately, were pushed into a higher tax band. Others lost child benefit due to the higher income child benefit charge. Despite warnings, HMRC and the government said that the impact will be minimal. Well, they were wrong. Let me give you a real life example. I have Elaine, a buy-to-let investor, a landlady who has one property in South London. She purchased this back in 2014, before Section 24 was introduced. At this period of time, her plan was absolutely clear. She wanted to have the rental income to help her pay for her children's university tuition, but also potentially an early retirement. Now, before Section 24, she was on track to do this. But by 2020, everything had changed. She can no longer deduct or fully deduct her mortgage interest. Her tax bill has shot up by nearly £4,000. That surplus she relied on, gone. Instead of saving money, she now had to dip into her own pocket to cover property expenses. And she wasn't alone. Thousands of landlords found themselves in the same situation. So like Elaine, now considering on selling up. Now, the Section 24 alone was bad enough, but of course, combine this with the increase of mortgage interest that we've seen over the course of the last few years, that combination has been lethal. Property Mark, a well-respected organization within the property industry, did some research with regards to the impact of Section 24 after several years, and the findings were clear. Firstly, it stopped investors buying more properties to an extent, but also stopped them expanding. Now, what was the impact to tenants? Well, increased rent, reduced maintenance budgets, risking safety and quality, limited ability to fund energy efficiency improvements, shrunk landlords' profit margins, especially for higher earners. So what did landlords do? Well, a lot of investors decided to incorporate to be more tax efficient. Others, well, the admin, the cost and complexity is far too much for them to incorporate. So they either downsized or decided to exit the market altogether. Here are a few quotes from the report. We are selling one flat to pay the mortgage off for another two and reducing the mortgage of a third flat, reducing the letting stock for renters. And here's another. All headroom has disappeared. So not being able to cover mortgage rates, I'm selling all my properties in a fire sale. Since the announcement of Section 24, we have been moving properties into limited companies. This is effectively a sale, so it has been an extremely expensive process. Moving away from tax for one moment, if you want to find out the 10 government policies that killed UK property, make sure you watch my next video, also in the description. So for those landlords who wanted to remain in the property industry, naturally that created a rise in limited companies incorporating to keep their buy-to-let properties. In fact, there are now over 400,000 limited companies for buy-to-let. In 2024, 61,000 plus new buy-to-lets were created. Incorporation allows 100% mortgage interest relief, corporation tax 19% instead of income tax up to 45%, more flexibility for reinvestment and pension contributions. But of course, as we heard, transferring properties does have its cost, including but not exclusively stamp duty and capital gain tax. So a lot of landlords moving towards incorporation to stay within the industry.